Kevin O'Leary, it's a big call by a guy who's bullish a lot of the time. The question is he right with his premise being, look, until the Fed does anything to be, quote unquote, hostile, the market's going up.
Yeah, is he right? Yes, but the real question is, when is he right? Now, let's just use a very easy measure in terms of inflation. The handle on the 10-year has to break through 3. Got to be over 3% for it ever to become competitive in fixed income against hard assets and equities. And we're nowhere near there. I do agree, and I've been bullish along with him on for the third and fourth inning of this game, and let's call it third and fourth quarter. We are way underestimating earnings in the S&P 500, in my opinion. I suggest that what's going to happen in the fourth quarter, and the market's trying to figure this out every day, with all the cross currents going on, you know, inflation, no inflation, and everybody else saying tech is over, and all of these cross currents. Bottom line is, I think where we end up at the end of the year is GDP growth rates north of 8% and probably 15% higher in S&P earnings. It's going to be a blowout ending of this year, something we haven't seen since the 1950s. And why? Well, thank you, Fed. Thank you, President Biden. Free money out of helicopters from everywhere. Free money. 1.9 trillion in free money, and now another $1.5 trillion of free money. Keep it coming. It doesn't get any better than this. You'll have to pay for it one day, but hey, let's not spike the party yet.
That's why Pete Siegel thinks what he does. I mean, this was a week in which we heard the word Goldilocks be mentioned once again. For all of the reasons that Mr. Wonderful just said, and the reasons that Jeremy Siegel cited why he thinks we are in the third inning of this boom, that you've got between now and at minimum the end of the year to think that stocks are going to go up before you have to worry. Is he right?
Well, I'm not so sure that I believe before you have to worry, but I certainly think that the overall theme right now, Scott, when you really look at things is, look, we continue to throw trillions of dollars, as Kevin says, free money continues to flow. And as that flow is happening, we're also seeing the vaccines as they're rolling out and the acceleration of that and the reopen and all of that goes into what we are seeing in the markets right now. And I think that very healthy rotation from sector to sector to sector, and even the daily sort of rotation that we are seeing. One day, it seems like it's the Nasdaq that's going to lead us. The next day, it's the Dow. The next day, we're seeing more from the S&P. It's just been a combination of a lot of very positive things. I don't know that that can go on forever, but certainly saying it's maybe in the third or fourth inning makes a little bit of sense to me. But I think the reality is, look at the volatility of how low we have gotten. I mean, we were not too terribly long ago trading in the 30s and 40s, and here we are now in the teens. And I think that gives people a little bit more comfort in terms of a lot of different ways, Scott, because when they see that, they realize, and everybody always calls it the fear index. I don't agree with that as the moniker, but it is oftentimes called that, and people are looking at that saying, hey, look, this is telling us something, and it's telling us we don't need to be afraid right now. I don't necessarily subscribe to that, but I do think that people are feeling very, very comfortable as they're entering the markets and shifting around and being much more involved in the markets than ever before.